the tweet I put out this morning, I said that we would likely see a limp opening. That means it's anemic. It doesn't have any kind of real excitement. And it's because we don't see a large gap between where we settled at 4:15 or 4:14 p.m. Eastern time yesterday to where we opened up at 9:30 here today. So if we click on regular trading hours, this candlestick right there, right here, that is the 4:14 p.m. Thursday, September 19th, 2024's settlement price. Now it trades for another 45, 46 more minutes and then closes at 5 o'clock. But this is what you're looking for the opening range gap. If we open, and the next candlestick shows this, 9:30 a.m. today, Friday, September 20th, 2024, that opening price sets the stage for the other parameter for the opening range gap. So since yesterday's settlement price is higher than our opening price today at 9:30, that means we have a discount opening range gap. That means today's opening price at 9:30 is lower than where we closed at 4:14. All right, so here is the first fair value gap between 9:30, technically 9:31, to 10 o'clock. That 9:30 to 10 o'clock is an interval of time that I dub a opening range. So there's two things occurring here. The opening range gap, which is a lower gap opening, which is that candlestick there. And this line, if we were to scroll all the way to the left, which I'm not going to do, would go right back to yesterday's 4:14 p.m. Eastern time settlement price. So it's this line here, that bold line, and this bold line. I'm making it as maximum size as I can. Between those two price points is the opening range gap. Opening range, which is algorithmic, anything less than this, they're making up stuff, let's put it that way. This is the first 30 minutes of trading. Okay, the algorithm is going to use this range for several things. The first fair value gap that forms occurs at 9:34. So it meets the minimum criteria of at least the 9:31 candle, because you can't use the 9:30 candle for the initial fair value gap or the first fair value gap presentation between the 9:30 and 10 o'clock. This is called time distortion. It's waiting for a specific time. What time is that? It's 9:50 a.m. Okay, so 9:50 a.m. to 10:10. That is a algorithmic window of time where the market will start to spool. That means it's going to run. Okay, so this initial fair value gap, because we opened up, and you should have this in your notes as well, whenever we open up, and if you have a very small opening range gap, well, what is that? Well, it's 20 handles. And that's exactly what we had here today as an opening range gap. Because the high of it, which was yesterday's 4:14 Eastern PM session settlement price, was 20,055 for the micro NASDAQ for December contract. And then we opened today for the same market here at 20,035 even. So between those two prices, that's only 20 handles. So that's a really limp or anemic opening gap. It's not a lot to get excited about. Plus, we had a large range day yesterday. So in the morning, it's going to be a little bit more difficult. And then you compound that with a Friday where we've already moved a lot. So it's going to be a whole lot more things that's going to go against you. So you have to really stick to time. And the other time, if there's a lot of volatility, you don't have to require my macro times. I don't require my macro times when there's a lot of volatility. But when there's things that are stacking against you, like we have a small gap opening, it's Friday, we're at the end of the week, and well, that's enough. The small gap and a large range day yesterday already puts the focus on the morning session is going to be a little bit more challenging for someone that doesn't have experience. So what occurs here is when the market opens up at 9:30, it rallies and takes out a short-term buy side liquidity. So it engages that, knocks out anyone that's already short, so they can't capitalize on that. And it puts traders that would be a buyer above this old higher here, that now they're trapped in it long. So they're going to rake them across the coals to this area of sell side. So their sell stops below here. So they take traders in prematurely by taking out this high there. So now they're thinking it's going to break out and keep going higher. It's not. The market's going to trade. Yesterday's gap did not get traded to the midpoint. And it barely made an attempt to get down into it. So because it's Friday, because it's TGIF is a scenario I like to look for the weekly range, whatever the highest high and the lowest low is. And I'll include this information in Caleb's video tonight. Okay, so on his channel, what I'm referring to by TGIF and what that means and how to determine what that looks like on your charts, I'll show you what that is. It only takes me a minute to do that. But it's likely to see a pullback on Friday to 20 to 30% of the weekly range. Not that it needs to do that, but I'm always looking for something like that to unfold. And because we have a low, exciting, lack of excitement opening range gap, because it's only 20 handles, it's not going to be requiring much, I guess, participation right away. So wait. So what that means to me is I'm looking at that gap here, and I anticipate that they're going to work both sides of it, back and forth, back and forth, back and forth. And I'm going to draw it correctly so that we can see it real quick. That's what it would look like. And I'll get to the breakaway gap in a second. If we know that we have a very small gap opening, and we have a Friday, end of the week, and we have a large range day yesterday, we're going to be opening up close to what else? What was the first comment that I was asking you about today on Twitter? Have you extended yesterday's first presentation fair value gap between 9:30 and 10 o'clock? That's what this orange box is here. This orange box is yesterday, Thursday's first fair value gap between 9:30 or 9:31 to 10 o'clock in the morning, Eastern time. The same way this is for today, the first fair value gap. You want to extend them forward, and their life cycle's about 3 days. Now, you're going to find that sometimes they'll still be useful a week, 2 weeks, 3 weeks ago. It hasn't been traded back to. Okay, that's usually how it works. But when we're in an area where it's going to be ranging around it, and notice that when we were close to 9:30, if you look at what the pre-market was doing, and because we're looking at electronic hours down here, it's because we're opening up right here at 9:29 a.m. That's electronic trading hours. You already can guess what the opening price is going to be. It's going to be below where settlement was yesterday up here. That's that price at 20,055. And it's, again, referring to this. That's where trading stopped yesterday. And then it starts here with regular trading hours. But between these two price points, all night long, we've had all kinds of trading back and forth. But when we get close to 9:30, at 9:29, you can see where we're going to be opening in relative terms to the 4:14 p.m. Eastern time settlement price. We're going to be opening higher or lower. And you can guesstimate, really, is it going to be a wide gap? And if it's not a wide gap, I don't like really less than 40 handles. If it's less than 40 handles, I'm using other tools that's going to help me for trading the morning session. Or I'll just opt out and wait till 10 o'clock and I'll trade silver bullet, something like that. So there's very simple rules. You see that? It's not hard. It's not complicated. But you have to have conditions and understand what those conditions are. And the same thing that we're seeing here is applicable to the CFD market. So you don't have to stress about, I don't trade futures, so I don't know how to make this work for me. So because we have a very small gap between those two price points, yesterday's settlement price and 9:30's first opening price tick, that's this candle's opening price. Where is that happening? Well, look at 9:29. Look at that candle where it's trading at. Before that candle closes, we're inside yesterday's first presented fair value gap, aren't we? Look at the orange box. So if we have the opening here today at 9:30, it's opening inside of yesterday's first presented fair value gap. So what does that mean? It's going to use that fair value gap, not just this one. And the first one that prints in during time distortion may not be all that influential. And it might be useful next week instead. You understand? So we have to look at this orange shaded area because that's yesterday, Thursday's first presentation of a fair value gap between 9:30 and 10 o'clock. That's why I asked on Twitter, I said, have you extended yesterday's or Thursday's first presented fair value gap? Have you made it so it's extending to the right on your chart? Because if you're not doing that, you're going to miss everything that occurs around this day. So when we're looking at opportunities for setups to form, when we're looking for things that build something that's predictable, something that you can forecast, something that you can anticipate and not be reacting. Today, what I was doing is I was watching this initial fair value gap and anticipating this back and forth time distortion where it's just going to be working what? What is it working? Well, we ran the initial level of buy side that was over here that was pre-session. So when we wicked above that over there, it went back down in, and what is it hitting? Today's opening price. What is the opening price at 9:30? It's the low of the opening range gap. So watch what it's doing. It's opening here. It swings up to the high, which is yesterday's 414 settlement price. That's the high of the opening range gap for today. Then it trades through that to get liquidity over here. And then it trades back down, overlaps the low or the opening price. And then what does it do again? It one more time reaches more buy side that maybe didn't get hit here. They're going one more pass in. And they're dropping it down again. Where's it going? Right down to the opening range gap low. If you're just looking at this, okay, or you're a dingleberry and you are out there trying to point to where fair value gaps don't work and look at this, they get ran through. It's designed to do that. It's designed to do that because you don't know what the fuck you're talking about. There's logic behind these things and you don't know what it is simply because you can draw a rectangle in one candlestick that is not bridged with the previous candle or the subsequent next candle doesn't make it a fair value gap. It makes no sense for anybody out there to assume just because you think you see it there, it doesn't make it a fair value gap. Just like every down closed candle is not a bullish order block and every up candle is not a bearish order block. So in here, once we got to, here's 950. Okay, that's this candlestick right there, 950. Now we're at the time. We're at the time when the market will do what? Spool. Now think about what has transpired. We had a nice up close week. We've had the market open with a small opening range gap, 20 handles. We opened in yesterday's first presented fair value gap. This gap here is going to be the least important. We ran back and forth over top of the opening range gap. And yesterday's opening range gap did not even trade to its midpoint or consequent encroachment. It barely made its way towards the upper quadrant. So there's a huge discount or a vacuum of price where there was no buying and selling because it never went down into its gap yesterday at much. So because it's Friday and TGIF is thank God it's Friday, meaning that it's likely to have a 20 to 30% retracement of what the total weekly range was. So there's a lot of things that could be built into expecting the market to work down below yesterday's first presented fair value gap. But you have to wait until the algorithm, not the buying and selling pressure kicking in. It's the algorithm. Okay, it's the price engine that's going to start offering lower prices. There's a short-term low there. There's a short-term low right there. There's a short-term low right there. There's a short-term low right there. And there's a short-term low right there. Okay. I used the easiest one that would be below here. So that's this one here. This one I'm not too concerned about. I ain't worried about the fair value gap, because if we're going to get down here, it's going to want to go below these relative equal lows. So from up here at 950, I'm anticipating the market at that time, it's going to start moving in that direction. That's what a macro is. A macro is a small list of directives that this program, because that's all it is, it starts processing and delivering on the basis of how fast it's told to do it, how many times it has to stop and create this scenario here, which is time distortion. You are all told that it's chop, or it's consolidation, or it's indecisiveness. It knows exactly what it's doing, folks. So when it drops here and here, and then the relative equal lows over here, right there, we can now anticipate that once we get through the bottom of this fair value gap, I've already removed my interest in it. I just want to see it trade below it. If it were to trade back up to it and bump it like an inversion fair value gap, all the better, fine. But because of this day being manipulated like it is, because of all the factors, Friday, small opening range gap, large range yesterday, so many things, and we open inside of yesterday's first presented fair value gap, that's a huge list of things that I need this to start moving in my favor. Because I didn't want my gap shown like this, I wanted to take away that volume imbalance, which is this candlestick's close and this candlestick's open. I'm going to take that away and put it just on the wick like that. So now I'm showing this candlestick's low, this candlestick's high, and I'm ignoring this volume imbalance because it's the least impactful or important thing, because this gap, the first presented fair value gap from yesterday, we opened in it. So it's been using it. So the algorithm's tipping its hand saying, this is the level I'm working with. It's the high of it, the upper quadrant, the middle, the lower quadrant, and the low. They're very specific prices. It's not a zone. When we're bearish, we want to see it not go back in the upper half once it goes down. What does that look like? Well, because I'm not looking at the volume imbalance here, I can then see this as a breakaway gap, which is what you'll see in the video where I'll annotate it. Okay, and I'll show you that this is what I'm viewing this as, a breakaway gap, meaning that because it's the time of the market wanting to rebook and price lower, and it doesn't have any effect on the buying and selling influence. There's no influence by buyers and sellers causing that. It's just artificially being delivered lower to take liquidity in here. What liquidity is in this area here? Nobody's actively going in and placing big bets there, but there absolutely was orders resting above this high, which they've already worked there. So what's the opposing liquidity? If this is the buy side that was taken, where's the nearest obvious sell side liquidity pool? Right there at that low. So the algorithm doesn't know how many contracts there are. It doesn't know. It doesn't need to know that. It just knows that that low hasn't been traded to. So let's start driving lower. And the macro is this. It looks back through the previous session. That's all it's doing, folks. It's very simple. It's going back through the previous session overnight, yesterday afternoon, this morning, London, Asia. It's just cycling back through the previous session. That's all these things are doing. This gap here tells me that I'm absolutely seeing what I expect to see, which is it's going to drive down to here. So once we enter with this candlestick here, inside this orange box here, that's yesterday's first presented fair value gap between 9:30 and 10 o'clock. Once it trades down like this, I'm waiting for it to come right back up and get the high of it. So essentially, what am I doing? I'm selling short when the market's going up on an uptick. So if we can anticipate the market trading in this candlestick here, when it goes up into the high, I have an opportunity to do it there, or I have an opportunity to do it right there. And then what happens? It breaks lower and trades to the middle or consequent encroachment of that shaded orange area. That's yesterday's first presented fair value gap. Once it does this, it gives you a breakaway gap. It runs into it, gives an opportunity to trade to the top of it, and then goes to the mid part or consequent encroachment of it, middle, and goes down below it. This candlestick here, we go right up and hits the middle or consequent encroachment, and then we leave that previous day's first presented fair value gap. Here's that candlestick right here. We trade into it and hit consequent encroachment of yesterday's first presented fair value gap. The next candle, look where my entry is. You see that? Watch when I hover top of it. See it? It's at the high of yesterday's first fair value gap. It's random, right? But ICT, why didn't you trade in the fair value gap? Why didn't you do something else? Because I know what I'm doing. I know what I'm looking for. Okay, so I'm entering at the high of that gap, and then I know I'm really on side because I have the breakaway gap. I'm in time, the time of the market being delivered algorithmically. I know that everything is in my favor, that this is going to go lower. Getting short here, then it trades down. It does not take the relative equal lows out yet on this drop down here. But what does it do? It trades all the way back up to some random level. It's the low of yesterday's first presented fair value gap. That candlestick hitting it. It's the first candlestick it touches it. Because I'm marketing in, you can see this. I have to do the market order because I have people believing that it's market replay. And you can't use the upper left-hand corner buttons for the buying and selling on market replay because they're down somewhere over here. So I do it that way. I could have very, very precise entries if I'm using limit orders. Getting in there, and then ultimately it trades back down and goes to that. See that little tick right here? That's below the relative equal lows over here. So entering here at the top of yesterday's fair value gap and getting out at the low underneath the relative equal lows I gave you on Twitter. If you look at this candlestick right there, this long lowest candlestick, let me get it out of the view of my little watermark here. This candlestick right here is the lowest of all the lows in here before we see this drop down. Can you agree with that? This one here is not being factored yet, not for my decision. While I'm watching the candlesticks over here, I'm looking at that one. So what I'm seeing is this. I'm measuring the body down to the low. Okay. If you ever see my charts have one single line and it just looks like it's floating out there around nothing, this is anchored to nothing that makes any sense. If you look back at my old recordings, even stuff on baby pips, you'll see me anchoring there, and that's the consequent encroachment of this discount wick. If I'm bearish, I can enter at that price. See that tick right here? Watch. See that? What's the price of the consequent encroachment of that wick right there? 19,974.25. This level here, let's scroll on over here and find out what that mystery is. I know you love it, don't you? Man, I can't wait to trade this way. I know. What do you think this is? That looks random, doesn't it? All this is the same thing. It's the consequent encroachment of that discount wick. But now I'm going to treat that as a target. So now, what is that price? 930.50. So I need that price or lower. And there's my exit right there. It slipped a little bit. 19,930.75. So that's not bad. It's pretty close, right? Close enough for government work, right? But all this drop here, I don't need that. And you don't need that either. And then what does it do? It starts to rally right back up. So all these things drawing right back up into yesterday's first presented fair value gap. Drops, rallies back up. What's it working? Yesterday's fair value gap. But now, late in the day, we're returning to first fair value gap. That's true value on the daily range. Your first presented fair value gap between 9:30 and 10 o'clock, you need to know what that is because the algorithm is going to refer back to it. Unless it's a trending day, it's going to refer back to it. the gap here, 414 previous day and 930 opening price. We don't have the what is it, US 100. And I'm just going to use this one. I'm not saying that that's a good broker. I'm not saying that you should trade through them. I'm just saying that this is something that you need to determine on your own. And if you do what I'm showing you here, you should be able to track price as close as you can without using the actual futures market. So if we pull that up like this, you can already see that I have the opening price at 930. There's the opening price at 930. And this settlement price here is yesterday's same 414 closing. So when we get to the candlestick at 414 yesterday, that's this candlestick right there at 414, the closing price. So while we don't have the break in trading between 4:15 to 6 o'clock restart, and we don't have the break from 4:15 yesterday to 9:30 in the morning in the CFD market, which is what this is, it is not necessary. All you have to do is know the same price points, and you'll have the same information here. Now the gap, the first gap for today, there is a volume imbalance here, and there's a volume imbalance here. Two schools of thought here. If you are using a CFD, always include your volume imbalances. Always. Don't do what I did today, because that's just experience. Always include them. That's why I teach, if you see a fair value gap, always include the volume imbalance, because of CFD and futures. I'm sorry, Forex pairs. Your brokers are going to screw you, and that's just the truth. And you're going to have different pricing. So if you don't include the volume imbalances, you're not going to have a true depiction of what you should be focusing on. So you can see here with the volume imbalances included, and that means that this candle is closed, the body's top to the next candle's open. That little separation, that's the volume imbalance. Just like this separation between this candlestick's close, or the high part of the body, not the wick, and then the opening of this candlestick, there's a small, look at it like this. You see that separation between the two bodies there, and the separation right here? That's my volume imbalance. The market here at 950, that's the macro time. 951, start going lower, targeting sell side, targeting relative equal lows over here. Same stuff happened over here. Ain't this a wick that I just talked about on the futures contract? Midpoint of that wick, get short there, and it drops.